Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video, I'm going to go through 5 quality businesses that are very undervalued at the moment. But before we do that, if you can give the video a like, that will be helpful. If you can subscribe to the channel if you haven't already, that will be absolutely amazing. But before we start the video and talk about these amazing 5 different companies that are very undervalued at the moment, what I want to talk about quickly is basically the earnings report. So tomorrow, which is Monday, basically the earnings report will start again. So it has been going on for the last couple of weeks. The banks have already reported, companies like Procter & Gamble and so on have reported, and they were okay. It was mixed. But this week coming, there are some big companies reporting, especially on Tuesday. Johnson & Johnson reports on Tuesday before the market opens, in the US market that is. 3M reports, and Union Pacific. So out of the companies that I own, basically these 3 will be reporting on Tuesday morning. Then we got Texas Instrument, Microsoft, Canadian Pacific, and so other companies reporting after the bell. So that's Tuesday. Then Wednesday, we've got ASML, which will be interesting to see what they have to say about what's going on in the semiconductor side of things. We've got Apple Laboratories, but the one I'm really watching, I'm hoping it goes down, is ADP, Air Product Automatic Data Processing. Is another company that I recently purchased. I only own one stock, so hopefully we'll see how that one goes. I would like to buy more of that. Then Tesla reports after close of the market closes. ServiceNow will report, and Lam Research and a couple of other companies will report. And then Thursday morning, basically there are companies like MasterCard that are reporting. I always used to think MasterCard reports basically after the market closes, but there you go. So this time it's actually reporting early in the morning. Then you've got Intel, you've got Visa, KLA, and so on. KLA is the company that I used to own in my portfolio before. I'm looking at it again for the family portfolio because there's not that many tech companies in that portfolio right now. So possibly adding that in the coming weeks if it kind of goes down, hopefully. So it will be interesting. And then you've got Chevron and a couple of other companies reporting on Friday. So one of the reasons I'm bringing this to you right now is just to kind of be mindful of what's going to happen. If any of these companies come out and they talk about recession and basically the economy is slowing down and things like that, then you will definitely see the whole market going down, especially the Microsoft and so on. So will be interesting to see. But again, as a long-term investor, do we really care what might happen just this quarter? Remember, we've been doing this channel for like 2 years now. And when we first started with the companies, the earning reports that we talked about at the time, do they matter to us right now? Absolutely not, because the market has gone up since. Okay, so yeah, we will see how things go from here. But the most important thing is that you focus on your own portfolio. You don't have to worry about what might happen in just this one earnings reports and so on. It might give you an opportunity to add to the companies that you own in your portfolio. So for example, I still need to add about £6,000 before the 7th of April. So for my ISA account. So I will be adding that, InshaAllah. So as much as we'll definitely max it. So we'll see what happens. And I'm looking around and thinking, okay, what company should I actually buy more of? And I actually added, I think it was £600-700 last week that I added. So I'm going to continue doing that in the next few weeks and see what happens. But yeah, that's where we're at so far in terms of the market. Let's now look at the 5 different companies that are possibly reporting in the next few weeks, and you might want to have a look at them. Okay, some of these companies are very undervalued at the moment, and to be honest, in my opinion, they are dividend growth companies. 3 of them I think are dividend aristocrats. One of them has been paying over almost 40 years now. They're increasing their dividend and so on. So let's have a look at these companies. And the first one we're looking at is Medtronic. Medtronic is a healthcare company. They do the equipment side of things. They might have a market cap of $104 billion. They have a wide economic moat, which means that company has a competitive advantage over the other companies in the same industry, if you like. Okay, they have the current price is $80 per share, dividend yield of 3.36%, which is very, very good for this company, and the 5-year growth rate of just 8%, just 8%, more than 8%, which is quite nice. Normally I'm looking for 6% or more. Okay, recently I've started thinking about, 7% or more. So from now on, I think I'm going to look for companies that are increasing that their 5-year average is basically 7% or more. Because if you think about it, it would be nicer if it was closer to 10 than actually being closer to 5, in my opinion. Anyway, so 7% or more, that would be great. Payout ratio is right now 49%. They have increased that dividend for 44 years, and annual payout right now is $2.72. So that means they will pay you $2.72 for every share that you own of this company. I own, I think, about 30 or 33 shares of this company. Safety, we basically, it's 99%, which means that's the highest dividend safe dividend basically pays, okay, or basically gives. So this website that I use, okay, sometimes Simply Save Dividend, actually gives this to different companies. And as you can see, this one here, it gives different ratings. That's what I mean. Okay, and as you can see here, the 99 is basically the highest any company can get. Profit margin is 14%, return on equity 8%, free cash flow or now almost a $5 billion. Total return in the last 10 years, we're looking at about almost 9%. Next year, they expect it to grow 3% and then 3% after that. That's one of the reasons that probably investors have not been basically paying attention to this company, and that's why it's very, very cheap for us right now. 28% discount right now, $112 per share is what Morningstar actually expected from this company. When you look at other companies, okay, other like Seeking Alpha, for example, according to Seeking Alpha authors, is actually strong buy from them, which is actually quite interesting. Normally they are the opposite, right? So you've got 3 buys and 3 strong buys, and no hold, no sell, and no strong sell at all from Seeking Alpha. And this is Wall Street, so 11 people are saying it's a strong buy, no buys, and 11 holds and 1 strong sell. And when you look at it, $90 per share is basically what they expect the price to be, and about 11% basically from where it is right now. So again, another quality company. One more thing I want to show you is in terms of shares outstanding. They have increased it in 2016, but since then they have been buying it back, which is quite nice. And total sales is actually increasing of this business, which is really, really nice, right? So the next company is, and just to be transparent, by the way, before we look at Nike, I own 32 shares of this company. I'm down about 13%, and I am buying it regularly. Every week I buy at least 1 share or 2 shares of that company. I want to have at least maybe 50 shares of this company in the long run. So I will be buying it more of in the next few weeks and months. So next one is Nike. Nike is a consumer discretionary company, meaning their products are not necessity. So that is the difference between healthcare and necessities. Obviously, you can tell the difference, right? Even if we hit in recession, healthcare companies will still be okay, but companies with like Nike, for example, might suffer a little bit in terms of sales side of things. $180 billion market cap. It has wide economic mode, $126 per share. And then it has a dividend just above 1%, 5-year growth rate of 11%, which is quite nice. Payout ratio is low. 20 years of increasing that dividend, annual payout $1.36, safety 99%, profit margin 11%, and return on equity 36%. When we look at the free cash flow, $3.5 billion of free cash flow. Total return in the last 10 years is 17%, which is very nice. Next year, they're expecting the growth to be about 28%, and then growth estimate for the following 5 years is actually 7%. And then discounted right now about 6%, $134 per share is where the price should be. Before I show you the revenue for Nike, I want to show you Medtronic. Okay, so as you can see here, when we take out the estimates, you can see the revenue was growing, but it went down a little bit in 2020, and then it bounced back. But now there is a decline. So this is the reason why basically a lot of investors sold this stock, because they think 2023 is not going to be as profitable as before, but the company will bounce back. So 1 year or 2 years of down is not that huge for this type of business. For that reason, I'm actually buying more. And when you look at the same thing again, when it comes to EPS, is also a little bit of decline. But one thing I love about this company is this bit here. So the dividend growth from 2012 up until now, they have increased that dividend for 44 years in a row. But the last 12 years, you can see from $1.27 to right now, $2.65. Looking at Nike's revenue, you can see every single year it has been going up apart from 2020, and we know why. 2023 and 2024 are even better. Especially 2020, like from 2026 right now, 2022, which is basically last year's, right? 2023 is actually going to be even better. So it's almost a 3 billion, 4 billion difference. And then after that, it's almost another 4, 5 billion difference, which is quite nice. And then same goes for in terms of EPS. Okay, so they're expecting the EPS to grow up until here. And then obviously there's a little bit of decline in terms of EPS next year. But then the year after, it should be back again. And then when it comes to the dividend increases, look at this, beautiful. How amazing that looks. Okay. And again, it's not just the looks, but it's the numbers that are there to tell us the truth. Okay. Shares outstanding, you can see it's declining, which is absolutely beautiful. And the total sales is actually going up. This is really nice to see. This is a very well-run business, if in my opinion. Next company we're looking at is Roper Technologies. We talked about this company a few times. This company designs and develops software and engineering product solutions. The company offers management complex solutions, diagnostics, for example, laboratory information management, enterprise management, information solutions, transportation management, financial and compliance management, cloud-based in financial analytics and performance management software. You can see they do a lot of different things, okay? And right now they are basically $446 billion market cap. Yeah, they have a wide economic moat, $441 per share, dividend yield of 0.62, 13% in terms of the 5-year growth rate, which is absolutely amazing. Payout ratio 16%, which is really low. Dividend safety streak, we're looking about 29 years, so that is a dividend aristocrat. $2.73 is what you will get. Safety is 98%, which is very high. Profit margin 53%. Return on equity 22%. $1.1 billion of free cash flow. Total return, I wish this was a bit more, but because of the market cap is quite small, okay, that's okay. It covers the dividends and more, basically. Total return in the last 10 years, we're looking about 14.65%. Next year, 13%. Okay, and then basically 11% growth next 5 years. 17% discount right now. $530 is basically where they're expecting the price to be. When you look at the revenue, it's actually looking good. I mean, 2020, when they finished their last quarter, I think there might be a little bit decline, but then it is going to bounce back afterwards. Okay, if we take the estimates, you can see it's actually gone down 2020. Hopefully 2022 should be better. In terms of increasing that dividend in the last 10 years, you're looking at basically absolutely amazing in terms of graph. When it comes to the shares outstanding, by the way, if you haven't done it already, please give the video a like. It really helps the channel. Shares outstanding, as we're looking at right now, it has been increasing. It had increased and then it's basically stayed the same, and then increased a little bit. So they have increased it, which is not nice, but it's not a huge increase if you like. But when it comes to the total sales, you can see it's been going there. About 1 or 2 years it went down, but it is bounced back again, which is basically very good to see. So again, it's one of those companies that I actually like and potentially looking at to add into my portfolio. It's kind of industrial / software company. So hopefully, if it comes down, right now we're looking about 17% discounted with possibility of a margin of safety there. I don't know if the markets decline a little bit, I might start looking at this company. I've been saying that, but I think this is one of the companies I should definitely be adding to my portfolio, because I do like that consistent growth of dividend, consistent growth of revenue and everything else. But the shares outstanding is a little bit, that's the only thing negative I can say about this company right now. Next company we look at is Lam Research. This is one of the semiconductor companies. They deal with the equipment side of it. They don't actually make the chips themselves. Currently $56 billion market cap. It has a wide economic moat. $472 per share is where it's at right now. Dividend yield of 1.46, 5-year growth rate of 29%, which is absolutely huge. 18% only payout ratio. When it comes to the growth, they have been increasing that dividend for 8 years. $6.90 is what you will get for owning the shares of this company. 66% safety. Profit margin 27%, return on equity 74%, 3.2 billion market basically of free cash flow, which is really good. 28% return in the last 10 years, which is huge. Next year there is definitely a decline. After that, about 3%, 24% discount right now, and $620 per share is where it should be. When you look at the growth of the revenue side of things, you can see it's heading in the right direction in 2023. Then there's a bit of a decline. Okay, so that's probably one of the reasons why the stocks are down a lot, and obviously because of the technology companies are down so much this year. And in terms of dividend growth, they started in 2014, and since then they have actually been increasing that dividend, which is absolutely beautiful to see. Finally, I want to show you the shares outstanding of this business. As you can see, beautifully declining every single year, and then total revenue sales, they're basically increasing every single year, which is really nice. And the final company is one that I own in my portfolio, and that's Air Products and Chemicals. That's in the material sector. $68 billion market cap. It has a narrow economic mode. $304 per share is where it is right now. Just above 2% dividend yield, 5-year growth rate 11%, payout ratio 61%, dividend yield dividend streak of basically increasing that dividend for 40 years, $6.48 is what you will get. Safety 95%, so that is very high, which is absolutely amazing, and it makes me comfortable knowing that although they have a less money in terms of free cash flow here out of all the companies that we talked about today, their safety side of it is 95%, 17% profit margin, and then 16%, almost 17% as well return on equity. In the last 10 years, they've actually returned to shareholders total return of 15.44%. Next year, growth about 10%, then 11% every year after that. And this is one of the reasons I own this company. They're very predictable business, and they are growing their business, which is quite nice. 7% discounted right now. $327 per share is where the price should be. In terms of revenue growth, you can see it's beautifully growing every single year. This year, $12.7 billion to $13.37, and then $14.12. That's basically absolutely amazing that we're looking at annualized. And then when you look at the annualized earnings per share, it's also heading the right directions. And check this out. Look at from 2012 to right now where they are. They have increased that dividend every single year. All of these companies that we talked about today are Sharia compliant, and from that side, there's no issues. Okay. The only one I would say is basically right now is Medtronics. Medtronics is about 23% when it comes to interest-bearing debt, but that I don't think is going to be a matter. I think it was because the stock price has gone down quite a bit. That's probably why. It's not because of their debt levels. So all of them are Sharia compliant, really good companies. The growth side of it it looks really good. There's not that many companies, honestly, that can actually give you this type of returns, okay, as well as obviously grow their business and discount it right now. As a value investors, people that are looking for stocks that are undervalued and so on, this is very important to me, and this is what I look for when I see companies like this basically that are cheap right now. I will be buying more. I was buying more of Air Products and Chemicals when it was down so much, and look at it right now. I think I'm up about £700 because I was buying when this company was very much undervalued, and it still is. So I don't want to average up, so that's why I haven't bought more of. But guess what I'm doing? The other one that's in my portfolio that is really cheap that we talked about today is Medtronic. So I'm buying more of. I'm not saying you should go away and basically buy this. Obviously, you have to do your own research and everything. But for me, it's definitely a buy, and I will be adding this to my portfolio. Right, if you haven't liked the video, please do so. It helps the channel. And what I'm going to do is next couple of days, inshallah, once my voice is slightly better, I've got another video I'm going to record today or tomorrow. But inshallah, after that, I'm going to take a little bit of break. If my voice gets better, inshallah, I will be recording more. Have a wonderful day. Assalamu Alaikum.